Yeah, we're a little bit conservative on our underwriting. Really conservative on our underwriting, and we're still projecting these returns, which frankly, they're quite amazing compared to what I normally do. And so let's take a look at some of our key assumptions in our underwriting, because these levers, you could be less conservative on these levers and make the numbers look better, and vice versa. It's a balance sometimes between how you project these. So the key projection is one of the key projections is the appreciation rate. So we plugged in 3% annual appreciation in the value, the income, and the expenses. Straight line 3%. It's usually what I underwrite my deals at. Like we mentioned earlier, Shearerville has experienced 5.5% average over the next 10 years. Now, nobody knows what the future holds, right? I feel like 3% is a safe bet. The reality is I went through the boom and bust of '07, '08, and I feel like, and everybody that I talk to that's a big player in real estate right now seems to feel like that we are somewhere at the bottom of a market cycle, right? And if that is the case, I would just naturally expect that we are going to experience a whole lot more appreciation than 3% over the next 6 years. I'm hoping so. I'm going all in, right? But this is how we pencil it out, and it's still projecting these amazing returns. Vacancy. So like we mentioned, the first year we're doing a big project. There's a lot of units we're going to turn over, and so we have an entire schedule that does the math on that. And the math on our schedule is this is padded from that. So if our renovations go exactly how they're planned, I think it said that we would be at a 16 or 17% vacancy rate. And what happened is we added some extra time for our turnovers. So that 16% vacancy rate means we could do the renovation on a unit in 30 days and we could get it leased up in 30 days. So a 60-day turnover time per unit. We padded that to 75 days in case we get some inclement weather or whatever. That bumped up the vacancy rate to 20% in year one. And we went ahead and added an extra 3.5% just to be ultra conservative. So 23.5% vacancy in year one. After that, we moved the vacancy rate after stabilization. Year two, we have 10% projected. Year three and on, we're at 8%. So an 8% fully stabilized property, that equates to 2 units vacant at the entire time after stabilized. Mike, what are your thoughts on that?
Yeah, I think that's very conservative underwriting. I agree with it. When we looked at it as far as the 75-day cycle and a turnaround, I mean, that's plenty of time. I've done my luxury vinyl flooring, as I mentioned earlier. It only one-man job. It took me a month to do that. So imagine a team, imagine constructors, imagine professionals doing that. And with a smaller space as well. So we should be able to knock that out very consistently without any problems. We should have enough time to do that. So I think we're being very conservative on that vacancy rates, and especially when we're trying to stabilize up in the second year and the third year. I think it's right in line with the market, if not better.
Yeah, so the Indiana state average was like 7 point something, and everything that we find out about Shearerville indicates something less. There was a stat we saw at one point, November of 24 was 1.5%. We've seen stats in the 4.5% range and sixes. So I will say here in Maricopa County, we've had record evictions this last year in 2023. So vacancy rate's been pretty high. And so if Indiana is experiencing something similar to that, and it's still got a 7 point something% state average for vacancy rate, I'm already seeing that vacancy rate drop quite a bit. Like the occupancy is picking up in the last quarter for sure, for me and everybody else I know in Phoenix. And I would imagine the same thing is happening, but maybe on a smaller scale, less percentage wise in Indiana. All right, so we talked about vacancy. What about the rental rates? That's the income driver. We mentioned we want to rent these for $20.95 per unit. Right now they're renting for $14 to $15.50. So the comps out there range from $2,000 to $2,500. And when we look at what legitimately would the comps be, and we average them out high to low, the average is actually lower, or the average is higher than $20.95. So what this means is we're going to have the nicest and newest units for the average price. We are not trying to push the market rate. We're not trying to do something that hasn't been done before. We are not like getting risky in this department apartment. This is an ultra conservative rate, and just another reason why I'm really confident that we're going to over deliver on this project. And then lastly, the reserves. Okay. So in that $2 million raise, we have 143 upfront reserves just to have padded in the bank account for us. And what that we came up with that number because it's 1 year of mortgage payments. 143 just sitting in the bank. We're also in the P&L includes a $6,000 a year addition to the reserve budget. So we're going to have plenty of money in the bank. There's going to be zero financial distress. And that's all included. And so that's another lever that people can pull. If you under raise or don't figure on those reserves, it just makes your numbers look better. But we are over raising and still delivering great numbers. And then the renovation budget, our total budget for the project equates to $25,000 per unit. It's $20,000 for the interior and $5,000 for the exterior, and $20,000 a unit for a 1,350 square foot condo is going to go a long way. And Mike's got resources out there. Go ahead, Mike.
Told you yet, but I actually got a call today. As you know, this is near my hometown. I've got family out there, and they've been seeing the marketing going out on the web and social media, and they've already called me. They've already got four folks or four families that want to rent the apartments or the condos already. So they also mentioned that they're looking for really nice condos just like this, or living spaces with affordable rents just like this, so they can commute from Chicago and back to Indiana and enjoy the taxes. So that just speaks volumes of the market and what the tenants are looking for. And this is something that they're looking for.
Yeah, good stuff. So all the major levers that you can pull and be over conservative or under conservative are right here. And honestly, like, this is way more conservative than I generally underwrite deals in Phoenix. And we're still delivering returns that look better than what I do in Phoenix. And so I think we're going to even over deliver on these, but that's how it's shaking out.